18,170 is what the Nifty has touched this morning, while the Bank Nifty is gaining from the front, up about 127 points.
Nifty went and hit an intraday high of 18,200. Then the fall from the top, the slip, the profit booking. We went down to levels of 18,123.
Nifty is at that 18,114 mark. The high of the day, that is 18,201, has been acting as a resistance.
Initial gains are all but gone. A bit of a disappointing day after, what looked like a pretty strong session.
Well, it was a day where we traversed about 150 points on the Nifty to eventually account for absolutely nothing. It was choppy, it was range-bound, but it was in a narrow range ahead of major cues next week, the US Fed-related data, the RBI policy meet, but above all, we have the union budget as well. You're watching us here on Markets Today, the show where we highlight 6 hours of day's trading action in 5 headlines. From CNBC-TV18, I'm Manglam Malu. Let's talk about those headlines. Indian indices closed flat after recovering from intraday lows. Broader markets underperformed the benchmarks while IT stocks continue their gaining momentum. The market breadth favors declines, with 3 stocks falling for every 2 that gained. Auto major Maruti posts a strong third quarter number that sees profits double and operating margins improve. It's a tepid third quarter for Colgate. The FMCG major missed street estimates on revenue, margins, EBITDA and the net profit. The stock closes with 2% cuts. A drop in its Exim business and a weak third quarter performance puts Container Corp lower by almost 3%, whereas Axis Bank slips 2% despite reporting strong margins and improved asset quality, as concerns about a slowdown in its retail business and elevated slippages weigh on the stock. Gland Pharma also hits a 52-week low after revenue and profit come under pressure for the third quarter in a row. Amber Ent surges 4% on a strong third quarter performance, with both its revenue and EBITDA beating street estimates. Meanwhile, Supreme Industries also gained about 2% after reporting revenue growth of 18%, even as margins slipped. Crude touches a 2-week high on optimism of continued Chinese demand after holiday traffic in the country bodes well for fuel consumption. IEA, OPEC's bullish demand outlook for the year also supports. All right, so those were the top headlines for the day. Let's start with the market action for both the Sensex as well as the Nifty. They recovered from intraday lows to end flat. The broader markets were under pressure and underperformed the blue chips. The Nifty mid-cap and the Nifty Bank ended about 0.25% in the red. So, just look at the market from a closing basis. The Nifty ended absolutely flat, closer to the flat line ahead of expiry tomorrow. Remember, on Thursday we do have the Republic Day holiday, so tomorrow is when all the options and futures of the January series will be settled. The Nifty continues to trade in a narrow range. If you just take a look at the average range, which is the high minus the low of the Nifty over the last 5 trading sessions, it's been a measly 150 odd points. Today as well was close to around 120 points, and on some days it's been less than 100 points as well. So that's less than 1% in terms of an overall day's trading range. If you take a look at the indices today, it was the auto sector which was the top performer, and that was on account of Maruti's numbers, which we'll talk about. That was also on account of Tata Motors, which reports its numbers tomorrow, and Bajaj Auto did well too. Nifty Bank continues to underperform, and the mid-cap index weakness is something that we'll be watching out for. This year so far, there's been a stealth bull run on the IT pack, a 6% up move in the IT index, as against the Nifty Bank, which has fallen by about 1%. Remember, all of last year, it was a reversal where the IT index massively underperformed the Nifty Bank itself. But we did have a few movers in the mid-cap end of things. Nykaa was one of them, up on strong volumes. They've announced a new CFO. A lot of people looking at this stock favorably after a big decline from the highs as well. Route Mobile, good numbers coming in out there. PVR was higher. Remember, Pathan, will be releasing over the long weekend that we have, the holidays, etc. So prospects for that look good. And Strides Pharma was lower post their numbers and the fundraising announcement that they've done. So that was the sum and substance of the market today. But let's get you some market opinion. Tata Mutual Fund's Rahul Singh says that the earnings season has seen a few surprises, with Europe doing better than expected. He's also added that credit costs of some banks is expected to come down, which favors well for them. Listen in.
I think there have been a few surprises in the results season where I think few segments, especially like Europe, has done better than expected. I won't go as far and read too much into macro or take too much of a call into macro as to what's going to happen in US in terms of a deep recession or a shallow recession or a budget cut. But on the ground up basis, yes, the companies seem to be holding up better.
On to the second headline now. Maruti Suzuki surged over 3% on a strong third quarter performance that saw the company's profits double and operating margins improve. Sonia Shenoy joins in with the details on that. Good number, Sonia?
Well, thanks a lot for that. As you rightly pointed out, very good set of numbers coming in from Maruti, much better than what the street was estimating. The big beat came on the margin front, and that's not just because of lower raw material costs, but across the board, employee costs, other expenses were all lower, and margins came in above 9% for the second consecutive quarter. It was a gain of 300 basis points year on year and 40 basis points quarter on quarter. But the raw material tailwind is a big one. So if you look at it just for this quarter, raw material cost as a percentage of sales was down 310 basis points year on year, and revenue growth as well solid, no complaints at all, 25% growth, EBITDA growth almost 82%, and profits more than doubled on a year on year basis. Now the management said that there were a couple of things that aided their performance this time. One was cost reduction efforts that they undertook. They saw improved realizations, favorable foreign exchange variation, softening of commodity prices, and higher non-operating income. In the negative factors, they said that there were higher sales promotion expenses. Of course, as we know, they had a couple of new launches as well. So that marketing and sales expenses hit their earnings a tad bit. The company is also very bullish. They have a very high order book at the moment, out of which from a 360,000 order book, about 119,000 is just from their new cars, the new sales that they've seen. So all in all, good set of numbers, and the stock is one of the big gainers today.
Indeed, Sonia. Thanks a lot for that. But from one of the big gainers, let's go across to a stock that was losing today, and that was Colgate, down almost over 2%. And that's after once again missing street estimates on their quarterly performance. If you just take a look at their numbers, revenues shy of 1,300 crores. The street was expecting numbers upwards of 1,300 crores. The net profit coming in at just shy of 250 crores, whereas the street was working with a number of 265 odd crores as well. The company's EBITDA too was below expectations, as a result of which the margins were subpar as well. 28% as against a CNBC-TV18 poll of 29.3%. What was it that stood out despite a weak set of numbers? One, gross margin decline moderated to about 80 basis points. Remember, in the first half of this year, we saw the gross margins decline by almost 300 basis points. So that's telling you that the raw material inflation worries are maybe coming off. And secondly, the company's increased its spends on advertisements. As a percentage of sales, ad spends have been over 13% now, as against about 11% what we saw in the same time last year. Will the benefit of this accrue to the company going forward or not? These are early days of the new MD Prabha Narasimhan, so the street will most definitely be eyeing any sort of improvement coming in on Colgate in the next couple of quarters. But for what it's worth, the third quarter extremely weak for Colgate. With that, we move on to the third headline for the day. That is Container Corp. Slipped 3% today after a weak quarter that saw a drop in the company's EXIM business. Now, for Container Corp as well, if you just take a look at the overall performance, we already know the company's volume performance. We knew it before the results because that's something that the company disclosed after the third quarter ended. But if you just take a look at the revenue, 3.5% jump in the top line, just over 2,000 crores, whereas the EBITDA declined by about 7% as compared to last year, and as a result of which the margins compressed as well. From closer to 24%, they've gone down to 21.5% odd. The net profit was higher than what it was last year, despite the EBITDA being lower, and that's primarily because other income came in at over 100 crores versus 56 crores at the same time last quarter. The EXIM business, which is the mainstay of the company, saw a 3.5% decline in their revenue and EBIT. The only silver lining was the margins were stable at 23.3%. Domestic business as well saw a bit of a decline, but the land license fee of the company was for the first 9 months of the year 288.5 odd crores, in line pretty much with the quarterly run rate that we've been seeing, 96 to 97 odd crore rupees. The stock was lower, but important to watch out for how it performs going forward, primarily given its trigger, which is privatization, which may ensue in the near future. With that, let's talk about the pharmaceutical space. They were also in focus, the pharmaceutical stocks, that is Gland Pharma and Indoco, as well as Strides Pharma. All of them reported their performance for the third quarter. Ekta Batra joins in with a wrap on those numbers. Ekta.
Well, yes, it was definitely a weak reaction for most of the pharma companies that delivered numbers today. Gland Pharma, for example, did miss estimates both on the revenue as well as the profitability front. They have, in fact, seen a decline in terms of the revenue and profit for the third consecutive quarter. The company did allude to a challenging business environment as well as supply chain challenges, which continue to weigh. Revenue was down 12%, profit was down 15% year-on-year, but the margins did improve on a Q-on-Q basis. Plus, the company does continue to have a strong amount of cash on books. Strides, it was a mixed quarter because the margins did improve to a multi-quarter high. The US business recorded the best quarterly revenues that they've seen. However, the company did report a net loss, which was on account of a joint venture plus inventory write-off on account of COVID-19. The company did receive some proceeds from a transaction which was conducted or undertaken with Arrow some time ago. So that has gone towards net debt reduction. Lastly, Indico, it missed estimates. It was a margin decline on a year-on-year basis as well as on a Q-on-Q basis, which really disappointed the street. The company also missed estimates that the street was working with at around 18%.
All right, Ekta, thanks a lot for that. With that, let's talk about Axis Bank, which was the other one which slipped 3% on concerns about a slowdown in its retail business and elevated slippages. This comes despite the company reporting strong margins and improved asset quality for the third quarter. And this was also the reason why the Nifty Bank underperformed today. Abhishek joins in with the details of Axis Bank's reports, Axis Bank's numbers, that is. Abhishek.
Well, Axis Bank did report Q3 FY23 results. P&L was strong. However, there are some flaws in their results. So the net interest margin is at 30-quarter high of 4.26%. NII growth quarter-on-quarter is best in 27 quarters and YOY is the best in 26 quarters. So a record high in terms of NII growth. They have had the best return ratios, both the ROA and ROE in last 7.5 years. Asset quality, gross NPA ratio and net NPA ratio are one of the best in 7 years or even more. The CASA ratio, however, on the flip side has come in at 44.5%, one of the lowest that you are seeing in last 5 quarters. Operating profit growth on a YOY basis is the best in 26 quarter, led by the fact that cost to income ratio is on the lower side at 9-quarter low. So restructured book as well as the watch list, they have reduced, which means the stress on the balance sheet is reducing. However, on the flip side, the deposit growth is at multi-quarter low of just 9.9% YOY, which is one of the weakest that you are seeing in 7 quarters. The slippages are on the higher side despite the fact that they have had one-off, and these one-offs actually have been continuing over the last few quarters. The corporate loan growth has actually driven the overall growth as well as the yield over here, and fee income growth has also come in largely from the corporate side. Entire banking sector actually is focused on the retail segment, which in Q3 FY23 for large banks has grown at 4.5% growth quarter-on-quarter or even more. But for Axis Bank, that growth is at less than 1.5% quarter-on-quarter. So that's another negative over there. P&L, both in terms of NII and PAT, it's a beat on our poll. Back to you.
All right, now let's take a short break. Come back. We'll be talking about all the other headlines. Stay tuned. Fourth headline for the day, a whole host of mid-caps reported their performance for the third quarter as well. Vivek Iyer joins in with a wrap on a lot of these numbers. Vivek.
Well, in the midst of a very hectic earnings season as far as Q3 is concerned, quite a lot of the stocks that we are highlighting were quite active in today's trading session. First on our list, Amber Enterprises. The company, however, while it missed analyst expectations as far as the gross margins were concerned, the fact that the con call, the company managed to highlight quite a few important facts and giving a reasonably good guidance was something that saw this stock make quite a bit of a sharp recovery. So revenues went up almost 38% on a year-on-year basis, EBITDA up 5%. However, margins saw quite a bit of a sharp contraction, coming in at 5.8% versus 7.6% on a year-on-year basis. Profitability coming in at 15 crore versus 33 crore on a year-on-year basis. What the management did say in the conference call was that the company would maintain an absolute growth of EBITDA by 30% in FY24 and FY25. Coming to Supreme Industries, while the numbers on a a year-on-year basis were a bit of a dampener. The management did say that as far as prices are concerned, the prices have bottomed out, and the company has actually managed to take quite a few price increases in the current ongoing quarter. Net profit was down 14.5%, revenues up almost 18.5%, margins coming in at 13.1 versus 16.3% on a year-on-year basis. UCO Bank, in line with the strong results that most of the PSU banks have delivered, this company too delivered a very strong quarter. NII up almost 10.7%, net profitability coming in at 653 crore versus 310 crore on a year-on-year basis. Net NPA as well as gross NPA too contracting both sequentially as well as on a year-on-year basis. Lastly, Chalet Hotels, this particular stock, saw a very sharp up move in today's trading session on the back of very strong results. Profitability of a little over 100 crore versus the loss seen last time around, and revenues up almost 75% on a year-on-year basis.
All right, with that, let's move on to a special now. CNBC-TV18 has compiled a list of the top 20 stocks to watch out for this year. It's a carefully curated list of companies that warrant a closer look in 2023. Prashant lists them down.
Well, today we bring to you CNBC-TV18's top 20 stocks to watch in 2023. This is a list of companies which our research team has on their radar, and you should too. Each of our research analysts will present the ideas over the next few days. What am I here to do then? Well, I'm here to give you a sneak peek into the list. Well, first up, let me say that this is not a recommendation list. This is a list of companies which have meaningful triggers lined up this year. Positive or negative, but meaningful catalysts. Over the next few days, we will put out these names in detail and explain what could change and what the impact could be. Well, let's get started then. Sonia has Maruti on her watch list. Maruti, remember, has lost market share due to elevated competitive intensity, lack of new models in the UV category, and production constraints. With a slew of product launches this year, will all of this reverse? Ekta is watching Apollo Hospitals. Will the delayed Apollo HealthCo's fundraise finally fructify? It's been long awaited. A fundraise in Apollo HealthCo is important to ease out cash drain on the core business. From the oil and gas space, Sonal has her eye on two names. First is Reliance Industries, which will see the ramp up of its FMCG business, the launch of air fiber for wireless broadband, and new affordable 5G smartphones to monetize its pan-India standalone 5G network this year. The second one Sonal is watching is ONGC, where the bet is that higher oil prices bring greater confidence in the predictability of ONGC's earnings and perhaps supports a re-rating. From the tech and telecom space, Rima is watching Bharti and LTI Mindtree. Now, Vodafone Idea is the catalyst for telecom. It needs a capital infusion or it needs a massive tariff hike very quickly to keep its head above water. Either way, it's likely to be closely watched by the leader, that is Bharti, and that is what Rima is watching. On the IT services end, Rima has her eye on LTI Mindtree. From the media space, consolidation seems to be the name of the game. Vahishta is keeping her eye on PVR. Upside synergies are possible as the PVR-Inox merger plays out this year. And with Sony in the driver's seat, the question is, will Z Entertainment see synergy benefits, improved governance, and sharper content creation across platforms? Will the cement space see consolidation this year? Nigel believes it could. He has two names on his radar, Orient Cement and Sagar Cement, two names he will watch out for. In the FMCG space, Mangalam is watching Colgate and whether the CEO, Prabha Narasimhan, who has been at the helm of Colgate for 6 months now, will she be able to arrest Colgate's steady market share loss and drive its diversification agenda? He also has an eye on Container Corporation, which is a privatization candidate. Now, insurance has had a tough few last years. My colleague Surbhi will keep an eye on HDFC Life from the space as new regulation by IRDAI has an impact on market structure in 2023. Will HDFC Life emerge as a winner? From the infrastructure space, will NTPC emerge as a key play on India's entry into the global green hydrogen market following the government's launch of the National Hydrogen Mission? And will L&T be able to turn around loss-making businesses and benefit from the government's continued thrust on infrastructure build? Vivek has both NTPC and L&T on his radar. In the banking and financial services space, Abhishek has 5 names on his radar. Bajaj Finance had a rare down year in 2022. Will it get back to its winning ways? With the government looking to sell a near 61% stake in IDBI Bank, this is the second stock that he has on his radar. Next two are merger situations. First is the banking behemoth HDFC Bank, which is set to see the home loan giant HDFC merging into it. Then there is the merger of IDFC First Bank and its ultimate holding company, IDFC Limited. And the last one Abhishek has on his radar is Paytm. Will Paytm keep the promise of turning profitable in FY24, and will markets come to accept it and show it some love? Well, as I said, these are the 20 stocks which Team CNBC-TV18 will watch out for in 2023. Our team will present each of these ideas in detail over the next few weeks. I want to reiterate once again that this is not a recommendation list, but merely a list of companies which potentially have triggers and catalysts lined up this year.
Prashant, thanks a lot for that. In fact, over the next 1 month or so, we will be talking about each of these stocks in detail, the stocks to watch out for. But with that, we move on to the last headline of the day. Crude oil prices, they continue to inch higher. As they say, crude oil is on the boil. Brent crude is trading close to $80 to about 10 days ago, and now it's closer to $90 per barrel. Strong demand outlook from China continues to keep prices higher. Many brokerages have predicted oil prices to actually hit the century mark in the near term as well. Manisha Gupta standing by with all the details on that one. Manisha.
Well, the crude oil prices have turned positive for 2023 and are trading at a 2-month highs, taking support from the fact that IEA and OPEC, both in their outlook reports, have suggested that the year could look at very strong demand. 2.2 million barrels per day is what OPEC believes, and IEA says that you could be hitting a record everyday demand as well going forward in the second half of this year. The China traffic, because of the week-long holidays, also bodes well for the price rise. And then the street is also watching out for the European Union G7 price cap on Russian gas, which comes in force on 5th of Feb. Ahead of that, there is jitteriness into the markets. Also, the European Union is trying to put a curb or an embargo on Russian oil by sea imports. That is something that the street also is keeping an eye on. The economic concerns, in the meanwhile, the weak economic data is something that also is keeping our prices in check. The markets does believe that it is going to be between $82 to $90 a barrel that the Brent prices will trade for this quarter.
All right, Manisha, thanks a lot for that. With that, we're out of time on this edition of Markets Today. But before we go, let's take a look at what market experts expect from the upcoming budget.
I would rather look at the extent of fiscal consolidation in this budget. According to us, the fiscal impulse has been very strong over the last few years. Now it's the time, in a cyclically adjusted way, to adjust for this fiscal impulse to be lower.
That commitment towards fiscal consolidation, getting it down in that 6 or below 6 handle, and continuing with capital expenditure, and not seeming therefore too populist. So if you concentrate on capital expenditure, you will be allocating less towards the populist schemes. That will be important in terms of as we look into FY24.